Good morning, folks. Happy Taco Tuesday to everyone out there tuned in. We're just getting the show underway here. Thank you for tuning in. And should be an interesting day. We've got JOLTS coming today. We've got a 10-year note auction. So we do have some event volatility catalysts, even though Fed Nest Day is taking center stage, to be sure. Still likely that we could have some decent movement if we get any real deviations, especially from that jolt sprint. Market's been watching that closely, parsing the tea leaves to try to get a better idea of what the Fed may be doing next. And of course, we're seeing a lot of variability about expectations for the rate cutting cycle. So that's another thing that the labor numbers are going to have a big impact on, is really going to be expectations, not just for this week. It's pretty much a sure thing that the Fed cuts by 25 bips, but really going into next year. Because right now, there's really not a strong sense that the Fed's going to be cutting much more than a total of 75 bips from this week through the end of next year. And there are a lot of reasons for that, but the main one is really the labor market hasn't cracked. So if it does, if we see signs of that, that could certainly shift expectations. So let's dive in. First and foremost, the disclosure, and I always like to say, I kind of give my risk management sermon, don't bet more than you're willing to lose. There's a lot of us, when we're putting money on the table, we call trading, often is the case, I see folks betting with way too much size and getting into trouble as a result of that. I obviously don't want that to be you. I'd like everyone that follows my work to be able to survive and even thrive in these markets, build your consistency moving forward, which means you've got to manage your risk before everything else. How much are you willing to lose? That's what you need to ask yourself when you're sizing your trades. So, a bit about me. I'm going to date myself here. I've been trading for 20 years. Going to be going on 21 years of trading next year. And the biggest point that I learned over my journey was how much more important it is for me and how I'm wired to take a more systematic approach. That's been incredibly important for my consistency and my success over time. Now, I'm going to be the first to say that everyone's wired differently. So what might work for me could be different for you. But for me, going that discretionary route where you're just kind of winging it, that led to variable results. I'd have really good periods of winning, of making a lot of capital, and then I'd have periods of drawdowns, and it just wasn't consistent. But when I started to shift to a more systematic approach, I noticed that documenting my trades and working on following those signals that I was generating was allowing me to not only derive more consistency, but also to be able to build a journal that allowed me to follow my trades, understand how to navigate them over time so that I could focus on what was working and understand more about what wasn't working. Now, if you all aren't keeping a journal, I strongly suggest that you do that because I think it's a really big part of shaping your trading journey, to understand and to be accountable. Because if you're not mapping out what you're doing, if you're not keeping track, then how do you know what's working? How do you know what's not working? It's not just, you're not going to be able to just use your memory of those trades. That memory is going to fade pretty quickly over time. So it's really going to be about having something you can look back on days, weeks, months, years later to get a sense as to what kind of trading works for you, appreciating that we all are indeed wired quite differently. And that's a good thing. There's nothing wrong with maybe you trading differently than me, than someone else, etc. It just means we have to spend some time getting to know ourselves and what works. And what better way to do that than to journal our trades and journal them in a way where you're not only just saying, hey, I'm buying this and this time. You're buying this. Are you buying it all, or are you scaling in? If you're buying it all at once, you're kind of assuming you're smarter than the market. If you're scaling in, you're giving yourself a little more wiggle room. You're letting volatility potentially work in your favor. What's your thesis for the trade? You should write that out because you'll start to learn what kind of approaches work and what don't. How are you feeling when you're getting into this trade? Are you feeling greedy? Are you feeling excited? Or are you kind of neutral? If you're feeling greedy, how do those trades play out over time when you look back at them? Well, you won't know if you don't keep a journal. But if you do start to record these variables and then you look back at them and you can create a composite of what's led to your more consistent trades, you can start understanding why. And you can't hope to have true consistency without the why and the how. Getting lucky isn't something one can do over time and time again. But knowing why trades are working can at least help us to sharpen our trading edge. Ultimately, that's what it's all about, right? We're trying to become better traders. We've got to acknowledge that our ego and our emotion are our biggest liabilities. And our biggest strength is data and leaning into it. So having that data to look back on, how did we do on this trade? How did we do on that trade? Why did we do well? That can allow us to build. And some folks listening are probably going to say, you know what, that sounds like a lot of work. It is, but it's a lot less painful than blowing up your account. This isn't just gambling with money and hoping for big, booms in wealth. Some folks, they might do that, but often they won't hold on to their money because they don't appreciate the process it took to make it. So they might just think, oh, I've got the Midas touch. I'll just go in on this next one. I'll size up my whole account and it's gone. That didn't work out so well. And that's often the case for folks that get lucky. Sometimes getting lucky earlier in trading is actually going to hurt you. So I'm going to get off of my soapbox on this, but I just want to say that's one of the biggest points. And if you want to learn more about my approach, check out my YouTube. The pinned video is about trading psychology. It's just less than an hour long watch. You can watch it at your leisure. You can even stop it right down where you stopped, come back later, resume. But it's a great way to, I would say, prime yourself for better outcomes, to master your own mindset. And again, it's a free video you can watch anytime. Now let's get to our weekly pivots here, and I'm going to post these on Twitter or X, whatever we're calling it these days. I'm going to post it on there so that folks can check it out. We can see that these are levels that the market tends to interact with quite a bit. This morning, again, we're just below these pivots, especially on ES. We're only about 9 handles below this. And we're going to get into some charts here. I just post those on social, just if you want those pivots for a reference later. But my take is we're in a holding pattern. We've got the Fed coming up. We could see this chart of the S&P 500 futures. We've kind of been trading in a range. It's not a small range. It's about a 5% plus range, but we've been trading in this range. And I don't think we're going to break free of it until the Fed renders their decision, and until Powell comes out and gives us his press conference. And the reason I think that's the case is this is not as sure of a decision as maybe the markets are factoring for. There's Fed funds futures are factoring for about a 90% certainty of a 25 bips cut. But there's a fair amount of dissent within the Fed. So Powell's job right now is to convince as many members as he can to vote for that cut. The less dissent, the better. The easier it is for the market to digest it, because then the market will expect future cuts. But it could still come out as yet another hawkish cut. And so that's going to be part of the risk going into tomorrow. The other part of it is, are we going to see in the Fed's summary of economic projections? That's their SEP report. It comes out once a quarter. The last one is in September. What their rate expectations look like versus the market, and be able to contrast that. Because digesting that SEP report will give us all, as market participants, a better sense as to what the committee is looking for. Now, there's obviously some big moving parts here. Powell's out next year. Likely around May. That's when his term expires. Trump has made it no uncertain thing that he doesn't like Powell, that he wants to replace him. And so he's lined up a couple other folks. Many of them are likely to be more dovish. And that's something to take into consideration as well. That you could see things shift as we get into 2026, as Trump picks a new Fed head, and then that Fed head becomes sort of the shadow chair. Because even though Powell will be officially the head of the Fed, is that going to matter as much if there's someone else who's about to become the Fed head and kind of take the reins of policy, talking about what he sees policy's direction being? So up ahead, we've got Fed Nest Day, we've got a cut. There's even some projections by banks that the Fed could shift to buying more short-term treasuries or T-bills as issuance increases, because we've seen liquidity drop out. We've seen the Fed actually end QT because of their concerns about liquidity. Yesterday, we had a reverse repo bid that was short of $2 billion. So you can see with that account used to be over $1 trillion. You can see how things on the liquidity front are drying up a little bit. Bank reserves have been another area where you've seen liquidity drying up. You can see how it's impacted things like Bitcoin, which to me are sort of speculative relief valves for excess liquidity. They've been pretty volatile. They're off their highs. So there's a lot of signs that liquidity has dried up a bit. And I think that's something that is beginning to concern this Fed. That's one reason they'll cut rates. It's probably another reason we might hear something about their balance sheet going into next year. They may not make the change this meeting, but they may at least allude to it. And what banks have talked about is the Fed increasing their T-bill purchases to 45 billion a month. Some of that is going to be shifting around from no longer reinvesting in mortgage-backed securities and some of the longer-ended tenors and putting that into shorter-ended T-bills. So we'll see if we actually get something that vaguely resembles QE. I'm not so sure that's going to be the case, but it could at least be a shift as to how they deal with their balance sheet maturing. Because you got to understand, like I know a lot of folks have said, oh, the Fed's doing stealth QE, they're buying treasuries here. Actually, what they're doing is they're just maintaining their balance sheet, right? When they were doing QT, they were maintaining the runoff rate. Now that they're sort of flat, they're saying, okay, we've got like, around 8 trillion on our balance sheet. We're going to maintain that. So when things mature, we're going to buy them back. That's of yet what's been happening. There hasn't been any real QE by the Fed. But, as time goes on and the economy shifts and potentially slows and weakens, we may see that come back into play. So for now, on this chart, really the top end of this around 6,900. We'd need to see a break above that, build some acceptance to say we're out of this trading range. On the bottom end, it's going to be just above 6,500. That's really the range that the S&P or the SPOOs have been trading in basically for 2 months now. So let's see if this week's Fed event is enough to sort of jar us one way or the other. I would suspect if we get a little bit of a dovish surprise from the SEP report and the Fed maybe sees rates coming down a little more next year, that could juice us up and out of this range. But we'll leave it to the Fed to give us that information when we get it tomorrow, 2 p.m. for the decision, 2:30 p.m. for the press conference. And the NASDAQ has a kind of similar look to it. You've got this trend line that comes back to the summer. And you can see we've touched down on it several times. And now it's resistance. It's really becoming overhead resistance. So that's another thing that we're looking for. Now, we've seen in our momentum indicators, tech stocks are starting to show some signs of life. So I'm really watching that as well. You're seeing kind of a broadening out. We had a very weak November in tech. You can see that in the chart here. Tech really rolled over, led by the NASDAQ and a lot of the heavyweights within the index. But we've seen a pretty nice rebound off those lows. And the question now is, again, going to come down to the Fed. It's also going to come down to Oracle earnings, which are also tomorrow after market close. That's one of the centerpieces of the circular AI deals that have been happening. We've seen their credit default swaps surge higher. That's insurance against a default on their debt. It's nothing alarming in Oracle, but it's just giving us a sense that the people that are buying the debt want a little insurance because some of this stuff is looking a little more speculative. Now, personally, I think Oracle may actually do what, sort of the opposite of what the market's pricing in, and it could actually post some pretty strong earnings and get a nice boost. But at the end of the day, that's going to be a big signal for big tech. How does Oracle describe their growth moving forward, especially as it pertains these AI data centers? How does the market react? I think that's what a lot of the AI growth narrative is going to key into this week. So for the S&P, we've got the Fed. For the NASDAQ, we've got Oracle as our big signal posts tomorrow. For now, we're in a holding pattern. And I saw someone asked about gold. This is what I'm looking for on gold right now. We're in this wedge. It's a rising wedge. I know that folks can look at this bearishly, and it may end up resolving bearishly, but I will say that up until now, every period of consolidation, including the one that we're in now, these tend to resolve to the upside when you're in a broader uptrend. And so I do think that we could consolidate for a while longer. We may break this range to the downside, maybe get back into the Ichimoku cloud top, as we have during some of these other consolidations, sort of around this area, around 4,000, 4,100. And, someone low-key mentioned in the chat, wondering about the big orders sleeping at 39.43. I'll have to take a look at that when we dive into Bookmap, but I will say that long-term, I'm still structurally bullish on gold, and I like that we're consolidating, because when you see commodities move, You really want to see, after a big up move, a period of digesting those gains. If you don't have that, you're not building the support you might need for the the next time you rally and then pull back. If you have these moves straight up, they often resolve with, well, a crash. And we're not seeing that in gold. We're seeing instead a move up, a digestion period of consolidation, a move up, a digestion period of consolidation. So far, still par for the course. The key three drivers for gold's rally remain intact. One, enormous deficit spending. Two, global economic uncertainty and geopolitical uncertainty. And three, overall monetary policy that is still probably, at least in my view, a bit too easy and getting easier. That is to say, the Fed's cutting into a labor market that's relatively resilient, into a government that's got record or near record levels of deficit spending with unemployment this low. So everything's just kind of supporting the narrative that there's the debasement trade, that it's still live in gold and, and in silver as well. Silver's been an amazing performer this year. And we're about to check out that chart. Silver's breakout is one for the ages. Now, is it extended here after this big move? 100%. But remember, this whole year I've been looking for silver to outperform gold to get back to those old all-time highs. We got there and we blew right through it. The end of October was very decisive because we were testing that old all-time high from 2011, around 48 bucks an ounce in silver. Not only did we close the month above it, but then we just continued to rally, right? We consolidated those gains, and then we rallied. We went right back to that area of resistance where there was some supply before from the last break, consolidated again, and then broke out with vigor. And now we're consolidating. We're building some acceptance above the last level of resistance. So silver's doing exactly what I want to see it do as well, to build for more upside. I think we could see $72 an ounce in the first half of 2025, and it could come as early as the first quarter. One thing to know about silver is when it gets moving, it tends to move and sort of overcompensate. It sort of exaggerates moves. And so I could see silver making these big moves and then coming back in and consolidating for a bit. But that outperformance that you're seeing of silver to gold, and of junior gold miners to senior miners, and of miners in general to gold, that's all the sorts of ingredients you want to see in a healthy gold market. A healthy gold bull market. And that's exactly where we are right now. So gold to $5,000 an ounce in the first half of 2026, and silver to $72 an ounce in the first half of 2026, both seem possible to me, given the backdrop, the macro backdrop and the momentum backdrop. And the sweet spot is when those two converge, and that's exactly where we are right now. And then finally, we can take a quick look at Bitcoin. This was the old chart from last week. Notice where we held. We were able to build support off that base. I really like seeing that. So it's starting to suggest that the near-term lows in Bitcoin could be here. And I just wanted to flash back to that chart from last week to show that. Now, we do have some exclusive deals. Bookmap is still doing their really awesome discounts, 50, 60% off. So if you go to traderade.com/bookmap and scroll down, if you haven't yet signed up for Bookmap, you can get 50 to 60% off your first billing period. They do these ridiculously good deals towards the end of November through the end of December. So take advantage if you've been holding off. This is a great time to sign up. And we've got 20% off Traderade as well. If you want to check out what we're up to, our cutting edge trading tools, actionable research and ideas, including absolutely nailing these calls in commodities this year, come visit us. Check us out at traderade.com and use the code Mayhem20 for up to 20% off. And the folks at Bookmap would love for you to share what add-ons give you your trading edge, and they will refund them for the Blue Jacket winner of this contest. So with all that being said, guess what time it is? It's time to get into Bookmap here. And I'm just going to take a quick look around the chats here. If anyone has any questions for me, by the way, feel free to drop them in the chat at any time. That's what this is all about. All right, so we've got the S&P 500 futures on screen. Let's just zoom out a little bit if we can. I'm just going to do a backfill, see if I can do a 12-hour backfill there. And just a friendly reminder, markets open up in just shy of 7 minutes, and we have JOLTS coming up at 10 a.m. So before you get too excited about the size of your position going into this trading day, my thought is watch the market open. Let's see that 20-minute opening range. Let's see where the flows are going in the SPX options visualizer, and let's parse this JOLTS data because we have information that could be market moving coming in. It's going to be kind of a binary event if it's an outlier on either side, and there's no real way to know in advance what that looks like. At 10 a.m., we're looking for JOLTS of about 7.117 million versus a prior reading of 7.227 million, and an outlier to the downside, let's say 6.9 million or below, would probably give us a bid in the rates complex. That is to say, rates would come down. It would probably increase the probabilities of further Fed cuts next year. And it could short-term pull the market, but then we'd get some relief. Now, if we get a big boost on JOLTS, let's say 7.4 million or above, I think rates could come up. Fed cut expectations may diminish a little bit. The market may have an initially positive reaction as hedges are taken off, but then we might sag a bit. That's kind of my take here where we are looking at some of the dynamics in the market and the way this data is taking shape. It's been a gradual slowdown in job openings. We would expect that to continue, but any outliers could reset expectations across the rate complex and risk assets. And good morning, Gary. Good morning, Low-Key. Good morning, everyone out there. Happy Taco Tuesday to those who celebrate. And remember, outside of JOLTS, we also have a 10-year note auction coming up at 1 p.m. Eastern. That's also going to be potentially important. Stop-throughs are bullish. Tails are bearish. You want to see a stop-through on that auction. We did see a stop-through on yesterday's 3-year note auction. All right, let's see if we can pull this back a little bit on the S&P. Nope, still not able to backfill that. Didn't look like it went all the way through, so I'll have to check on that in a little bit. For now, though, I will do that just in a slightly different way. Let's see what we can do. All right, here we go. We'll just use the FinViz charts for the moment. And let me make sure I don't crop off the timestamp on the bottom. So, just going to try to shrink that a bit. All right, so overnight, we can zoom out maybe to the 5-minute chart. Mostly a holding pattern, but getting back to the lows of that holding pattern, there was a big sort of de-risk earlier during the European session. Just trying to take a quick scroll to see if there's any news that stands out there, but I don't see anything really popping out. We do have some news coming out of China, and that is regulators in Beijing have been discussing ways to permit limited access to the H200. Those are NVIDIA's data center scale chips that the Trump administration is allowing the export of with a 25% tax on them. And that was around the time that that candle printed. So perhaps that's related. I would have thought that was somewhat good news, but we are where we are. Maybe the market didn't like the word limited purchases or the words limited purchases in that phrasing. What's interesting, though, is we're coming back down to that low pre-market. When that printed at first, we did see some pretty strong buy-side RVOL coming in. So there was buy the dip interest in that move lower, just like we saw yesterday into the close. There was that big interest in buying some of that. And of course, the next candle came right back up. This move lower, we're not seeing that same buy side interest. It's very tepid. So I think at least we're probably going to have to come back and test that low from yesterday, or at least this pre-market low. That's what it's looking like based on this overnight session. We're sort of consolidating, but overall with a bit of a negative bias coming into the open. So I'd watch that area as an area that could be a reaction zone. It's kind of interesting because it comes down to our midpoint from yesterday's options trading. And it's quite close to where the most active call strike was trading yesterday as well, around 68.48.75. And while we're in here, let's also just take a quick look at the futures heat map ahead of the open. So equity is across the board outside of the Nikkei, seeing just a little bit of selling pressure. Energy complex, another day in the red. Silver popping, getting back to the upper end of its range. And oil continuing to roll over, looking heavy again. It looked like it wanted to make a higher low recently, but I'm starting to get the sense that we're not out of the woods with oil. Maybe, mid 50s to low 50s for West Texas Intermediate crude are in the future here. And markets are opening. Seeing price push over that put wall. And we do see a little bit of that algo bracketing pre-market that happens closer to those contract rolls as well. This is one thing that TraderMap Pro can be pretty helpful for if you want to filter out that liquidity. There's a free version, light, and there's a pro version. Both of them are very helpful. The pro version's good if you still want to use icebergs and stops and other add-ons on that filtered data. Low-key says, tomorrow is a big day. Unfortunately, he's probably cutting, right? Yeah, I think he will. He's definitely got his work cut out for him. I posted an image that shows the disconnect within the FOMC. Basically, there are members that are in favor of holding. There are members that are favoring of cutting. There are members that haven't really clearly expressed what they're in favor of. So Powell's got to kind of herd all those members into the cutting column, or at least as many as he can. You don't want to see dissent, really, when the Fed minutes come out later, especially, folks could be saying, hey, I didn't want to cut because I'm scared about inflation. And then it becomes a bit more of a hawkish cut, a reluctant cut. So it's about how they kind of contextualize the cut, how Powell contextualizes the cut during his press conference, but it's also going to be about the SEP report, those forward-looking expectations for the economy, unemployment, inflation, and of course the Fed funds rate. And we have to deal with the uncertainty of Powell's replacement. Who's that going to be? What's their policy going to be? In all likelihood, it'll be quite a bit more dovish. And so will this SEP report be taken as seriously as those in the past, given that we may have a completely new Fed chair with a completely different outlook in May, whose name may be announced as early as January and then could kind of become a shadow Fed chair? So far, not a very big opening range, just about 9-10 handles. I like to see 15 or more handles, and I like to look for about a 20-minute opening range. I also like to look at that initial balance. That can be helpful for shaping trend days. What you really want to see in that initial balance is testing the low of it before you test the high of it. 75% of the time when you see days like that take shape, you resolve higher. You don't come back to those lows. So that can be helpful as well. Jonathan asks, what's the time for tomorrow's events? So the Fed's statement and rate decision comes in at 2 p.m., and then the FOMC press conference with Chair Powell at 2:30 p.m., both Eastern. Let's take a look at the NASDAQ. Ooh, NASDAQ getting some kind of big de-risking off the open here compared to the S&P. Looking at the S&P 500 heat map, big tech is weak. It's leading the way lower in the NASDAQ. NVIDIA down 0.8%, Broadcom down 1%, Meta down 1.25%, Tesla down 0.5%. But these are coming off their lows here, as is the NASDAQ. So it looks like some relative weakness in tech, some relative strength in some of the more defensive parts of the S&P, healthcare, utilities, real estate. Also, interestingly, seeing a bit of a bid in energy despite the fact that the energy commodities are down today. So noteworthy relative strength there. You got it, Jonathan. Happy to help. And again, a friendly reminder for folks just tuning in, JOLT's coming up at 10 a.m. That's going to be a report that most focus on the job openings of. But there's other data in that report too, including people that have been laid off, quits, etc., separations. So again, NASDAQ showing relative weakness versus the S&P this morning. You can see the S&P and these divergent paths. This has been a bit of a theme. Some may attribute it to dispersion. Some may attribute it to rotation. But at the end of the day, what we can see in the price action is the heavyweights in tech are showing weakness compared to the rest of the market outside of Apple, which has sort of inexplicably been a more defensive part of tech. Maybe because they're not spending aggressively in this more questioned AI growth narrative as some of their peers. S&P pushing to new highs here. NASDAQ off its lows, starting to look a little bit more sprightly, and the major tech stocks coming off their lows as we would expect as well. Let's take a look at Bitcoin as well, just for a quick heuristic of the risk appetite out there. It had made a new low ahead of the market open, but now it appears that we're coming off that. And I'm just going to quickly adjust something here. Okay, I'm going to have to roll that silver contract, obviously. But I do want to take a look at silver, so I'm going to pull that up. Give me a moment. That's going to be SIH6. So we'll let silver load there. And NASDAQ coming off the lows pretty healthy here, what we're seeing. A lot of those major tech stocks have also curbed their losses. NVIDIA now down just 0.7%. Google practically flat now. Microsoft down just 0.4%. Meta's the only one that's still lagging, down about 1.3%. But the rest of tech starting to see a bid coming into it. So Loki says sometimes I wonder if this is human trading or just algorithms playing around with price. Um, I would say it's a bit of both, but what makes the first and last like half hour of trading kind of bizarre is you've got a lot of institutional cross currents happening. So you've got folks that didn't finish up the orders that they needed to do yesterday, or have got new orders they've got to place today. A lot of that happens in the first and last half hour of trading, and those cross currents create a sort of more volatility. That's what helps to define the opening range. It often helps to set the tone for a potential trend day, but it's a blend, and a lot of that is the institutional order flow from both algos, but also from human trading desks. NASDAQ pushing to a new high now, making up for that relative weakness earlier. S&P just really never looked back. Once we had made a higher low, this thing continued to push. And we can see now we're getting a more appetizing opening range out of this. It's about 14 handles, now about 15 handles. So it's starting to look a little more attractive. One thing that's interesting about Tuesdays, just from a data perspective, double break Tuesdays happen about 60% of the time. That means you could break one side of the opening range and then subsequently break the other. So far, this is looking like a pretty constructive start to the day. And we'll start getting some of that flow data in probably about 6-7 minutes here. And I'll stay on for the JOLTS opening and reaction just so that you all are able to get a sense as to what my read is on that. With everything going on there, let's, wow, silver is just kind of all over the place right now, and I don't yet have the backfill enabled on this one, so I'm going to have to get that squared away. But we'll give it a little more time here, and I'll just shorten the time frame temporarily. And one does not trade silver unless one is okay with not the most liquid trading. As you can see, this thing only has about 4.7 thousand order book depth, but the bid side of that order book is heavy, twice as much than on the offer side. So to me, looking at silver here, this looks pretty bullish. NASDAQ was able to push to a new high. Then we got a sell, but that sell, this is showing some exhaustion here based on my seller exhaustion indicator. So we may actually balance out right around this point of control and continue this push higher. Pardon me. Meta continuing to roll lower, but the rest of big tech recovering. Meta now down 1.65%. But the other tech leadership stocks have come off their lows pretty meaningfully here. Tesla even breaking green, up 0.4%. Apple up 0.5%. So overall, the NASDAQ is looking pretty good. Whatever that initial flush was, there was a buying appetite down there. You could see, these more aggressive sells were not met with continuation. Buyers started to put up a fight, and you started to see more of that aggressive buy-side volume coming in. Let's take a look at S&P, and noteworthy that we're breaking over our pivot here on the S&P. And just give me 1 second. I'm just going to quickly change a setting on here. But yeah, look at silver. Silver having a nice bid behind it too. Buyers are getting a bit more aggressive. We can see that order book imbalance in favor of buyers. More than 2-to-1. This is what you want to see. Just a quick look at the liquidity heat map and the order book can give you a sense as to where the supply and demand is. And it's clear There's a lot of demand today. And there's more offers overhead, which may be somewhat counterintuitive to folks looking at this, but that suggests there's interest in higher prices. This is not an overwhelming amount of supply. Let's take a look at Bitcoin here. Bitcoin got pretty excited off the open, wasn't able to crack 90,600. Now rolling below the point of control. We'll see if this ends up making a higher low here and a continuation, but this order book doesn't look quite as good as silver. It's only 5.2 thousand on bid versus 4.1 thousand on offer. ES also has a similarly balanced order book, and you could see there was also that seller exhaustion print in ES like we saw in the NASDAQ, which led to a bit of a scalpable long, and then we're consolidating from there. One thing buyers were able to do on this move higher for ES was pull that point of control higher, which is healthy. You can also see that these sell side deltas on the session volume profile column, those are now being, those folks, if they were selling to open, they're offsides, right? So the further you push away from those orders to the upside, the more likely it is they get stopped out and they become motivated buyers. Take a look at the NASDAQ again here. NASDAQ looking a little bit weaker. It's just testing that point of control here. We see a passive bid coming in. There is some iceberg buying there. And we're about 5 minutes away from forming that 20-minute opening range. At that point, we'll also have some flow we can look at. We can see S&P now balancing out around this put wall. This should offer some options-derived support. It's also got confluence with the VWAP. That's that horizontal line, this white line under the session volume profile, and the point of control. So you've got sort of a trifecta of potential support around this area, making it more meaningful. If we do crack below, that would suggest sellers have the upper hand. But so far, buyers are able to defend this trifecta area of implied support here. Let's check back on the NASDAQ as well. NASDAQ order book a little heavier than that of the S&P. 3.5 thousand, 3.4 thousand on offer versus 3.2 thousand on bid. Microsoft now flattening out its losses. Broadcom flattening out its losses. Both closer to neutral here. Oracle green, Palantir green. These are all flipping. But Meta is continuing to drop, now down 1.74%. So mixed bag inside tech, but certainly off its lows. Also interesting to see some of the areas of the market that were bid a little more aggressively in the S&P earlier are coming off, like financials and healthcare. So an inner sector, inner industry rotation away from some of the defensive areas and back into parts of tech, all within the span of 15 minutes. And steady accumulation in the NASDAQ by some of these iceberg buyers. Nothing too extreme, but certainly an appetite for buying the NASDAQ passively here. Similar look in the S&P, just a passive appetite, especially buying into weakness. You saw that move lower that triggered our seller exhaustion, that was also met with a 100 iceberg buy. So that reflexive impulse to buy even micro dips remains quite intact in this market. And we are starting to see some flow coming in. The hot put quite a bit lower. I'm imagining that this is likely just-in-time hedging flow ahead of the Fed. We saw some of that yesterday as well. It helped to pull the market down. And basically, to understand more about why that is something to watch and how it works, if you've got folks buying a lot of puts in excess of calls across the chain, like we saw yesterday, up until the very end of the day, what happens is dealers then have to hedge that exposure because they're not going to simply just lose on the other side of that contract. In order to stay solvent, they have to stay delta neutral, which means the more puts that are bought in excess of calls, the more they have to short products like the S&P futures. So when hedging programs come in, that can pull the market down. Just like when these call buying programs come in and you've got calls being bought in excess of puts, that can create more positive liquidity flow because you've got market makers hedging that delta to become neutral, buying futures, right? That's why we like to watch the flow. Because if you look at the options complex, it is one of the primary drivers of the market. It's not the only one. There's obviously folks buying and selling futures, ETFs, single stocks, etc. So there's a confluence of different flows. But when they line up, when you see, say, for example, a trend day and the hot call is trading in excess of the hot put, and you kind of have this target then that option buyers are giving you, that can be very valuable because it gives you a good sense as to where you might want to take that risk down. We've gotten to one of these targets. The call buyers are likely to realize those gains. That's a bit of a liquidity negative. So there's going to be some resistance around there unless exposure continues to roll up. So it's always important to watch the order flow inside the instrument that you're trading, but also what may impact it. And in this case, that would be the options complex. And that's true of futures, just like it's true of popular optionable stocks like Nvidia, Tesla, Apple, Microsoft, Google, etc. Let's zoom back in here as we approach 10 minutes to go to JOLTS. We formed our 20-minute opening range, by the way, and it's not too bad. It's not quite all what I wanted to see, but it's about 14 handles, and we're breaking to the top side of it. And we're breaking to the top side of that range as we see options flow starting to build up. Right now, it's pretty balanced between the puts and the calls. What I'd really like to see is the calls take the edge here. So 30% or more volume between the two most active call strikes versus the two most active put strikes would be a good start. We'll check back in on that in just a little while. For now, we're going to zoom back in to the price action as we see a break above that 20-minute opening range. What I need to see here is more acceptance built above this opening range to validate that it's been a break. We do know, though, all these sellers that were trying to push this thing lower in the seller volume, session volume profile, they're increasingly offsides. They're increasingly becoming motivated buyers. We also see a change in character in this order book. It's becoming more bid heavy, 16,000 to 14,000. And some positive comments from White House Senior Economic Advisor Hassett. I don't anticipate mass job losses from AI. He goes on to say AI will turn out to be a good thing like computers. And looking inside the S&P 500 heat map, we can see that that bid into tech is continuing overall. Nvidia is still down 0.6%, Broadcom down about 0.5%, Apple up 0.6%. CrowdStrike, one of our swing longs at Traderade, continuing to build up almost 2% here. And Meta down 1.9%, just continuing to weaken. They recently announced that they're pulling back from this metaverse spending that's been a big hole in their earnings for a while. I mean, obviously the company's done well with their earnings, but if it wasn't for the metaverse, they would have done a lot better. They're starting to pull back, which I think makes sense. The metaverse was never a worthwhile pursuit because it already existed in the form of massively multiplayer online games. And there was nothing that Mark Zuckerberg's company could do to sort of disrupt that or make it a more sticky social platform. But Meta's adventures in AI are maybe not going quite that well either. And so that's going to be an area of consternation among investors. Where is all this money going? They plan to spend $600 billion in AI capex to build enormous amounts of data center compute without really the software stack to run on it that warrants it. That is to say, their progress in building models has stalled, even with this super intelligence team and all the hires they've made. Meanwhile, S&P continues to consolidate above the opening range, so I like the way this looks for a potential breakout. The one bit of caution I'll add is JOLTS are coming up in just about 5 minutes, and I'm just going to go over the numbers again for that. Forecast 7.117 million versus a prior read of 7.227 million. Below 6.9 or so would probably see a reflexive reaction to bid rates, risk off temporarily, and then the markets will probably come back as there's this idea that, hey, this is actually good for the Fed and for cutting more. The other side of that, if you get a big boost above forecast, let's say 7.3 million or above, you could have rates coming up. You could have a bid coming into stocks, and then you could have that sort of mellow out the other way because rate cutting expectations may become a little more conservative, and stocks could kind of give back some of those initial removal of hedges gains that we could see. So that's the playbook. Basically, either side, we may see a move that gets a little exaggerated that could be worth fading. Let's see how it goes. Let's also zoom out ahead of the event and just take a quick look at the flow. Big bid in that hot call above, but the puts have it here so far. 13,000 on the warm and hot put versus 8,000 on the hot and warm call. And again, I am going to say, I do believe, because I've seen this before, a lot of this is just-in-time hedging ahead of the Fed. And it's also noteworthy that the buying pressure for shares, for futures, for ETFs is exceeding the hedging pressure from those puts being put on. That's generally a good sign. And so circling back to the NASDAQ, just sort of consolidating. S&P is definitely showing more relative strength today than the NASDAQ. Seeing a little bit of a rotation back into some of those other areas of the S&P. Utilities, consumer defensives. Nevertheless, NASDAQ buyers have been able to pull the point of control a bit higher here, and we do see some more motivated buying. We also see a really big, for the NASDAQ, an 811 bid is really big. So seeing that below, that kind of is a line in the sand, assuming it stays there. And that's basically buyers saying, you know, we're interested in defending this price. You've got basically 10% of the order book right there at that order. So that'll be pretty decisive. Shifting back to the S&P futures, coming back to the top of the opening range and retesting it. Want to see this hold the top of the opening range, but, you know, JOLTS is going to do what JOLTS is going to do. Two minutes until market data from JOLTS. Again, expectation of 7.117 million. Prior read 7.227 million. And what we're paying attention here, the main JOLTS data, because it's more than just job openings, but we're really just watching the job openings. That's what the market's keying into. These are companies that have opportunities that are being offered. Many of them were ghost opportunities, as say you could apply for the job and there was really no job to be had. A lot of those ghost opportunities have shrunk, but they're not fully gone. So that is to say, JOLTS typically overstates the number of jobs that are available. Nevertheless, markets tend to key off this data mostly based on the trend. And what markets want to see now to justify a Fed cutting cycle is less job openings. Data in less than 1 minute here. "30 seconds. You can see the order book lightening up, not nearly as much liquidity around price. This tends to happen around these events. So one reason you want to be careful about sizing your positions when you have big events that could move the market and also make it harder to get good execution. "3 seconds. JOLTS comes in heavy at 7.67 million versus 7.117 million forecast. And our initial thought on this was that this could actually push rates higher, could give a little bit of a bid to stocks that then comes out. Let's see if that actually plays out. So far, the market reaction's been very muted. Starting to see some liquidity come back to the order book here near price. But that was a pretty big beat from JOLTS. That's not what you want to see if you're hoping for the Fed to cut more than 75 bips over the next year. Obviously, it's one data point, and it could be overstated, and we have a new Fed chair coming, so perhaps this is being digested with that nuance in mind. Nevertheless, overall, I like the price action we've seen today to lean long. We've had that 20-minute opening range, about a 14 handle range. We built to the top of it, broke out, built some acceptance, and now we're starting to see some of that flow on the call side pick up. So the last ingredient I really want to see is the call side continue to pick up here in excess of that of the puts, and then I think those can be targets for long trades, looking for a trend day to take shape here. Folks, I want to thank you for tuning in to this week's episode of Back to the Futures with me, Markets and Mayhem. You can learn more about my work by visiting Traderade.com. You can get up to 20% off using the code Mayhem20 at checkout. And to get up to 60% off your first billing period of Bookmap, visit Traderade.com/bookmap and scroll down to the special offers. I will catch you next Tuesday, same time, same place, for the next episode of Back to the Futures. But I will be back tomorrow to cover the Fed and Oracle as well. So stay tuned. Wishing you a great trading week ahead.